In this video, you will learn how to trade a complete top-down liquidity strategy using weekly bias, 4-hour market structure, and 15-minute precision entries. We will break down how price sweeps a major weekly high, shifts bearish on the 4-hour chart, and retraces into the optimal trading zone for execution. You will see how professional traders combine liquidity sweeps, change of character, fair value gaps, order blocks, CISD, and premium and discount zones to build high-probability short setups. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Now, let's begin. This framework is based on top-down analysis and multi-time frame alignment. In this example, we will use the weekly chart for bias, the 4-hour chart for structure, and the 15-minute chart for execution. The first step is identifying the higher time frame bias on the weekly chart. In this scenario, price approaches a major swing high, which becomes our main point of interest. Instead of expecting continuation, we anticipate a liquidity sweep above the weekly high, followed by price returning back inside the trading range. If that rejection forms a bearish reaction on the weekly chart, we then establish a bearish higher time frame bias. Once the weekly bias is confirmed, we move down into the 4-hour chart for structural confirmation. Here, we wait for a change of character or market structure shift to align the 4-hour structure with the bearish weekly narratives. After the structural shift forms, we define the trading range and identify the optimal trading zone, or OTZ, between the 0.618 and 0.786 Fibonacci retracement levels. From there, we move down into the 15-minute chart for execution. Inside the OTZ, we will focus on two different entry models. The first uses a fair value gap and order block reaction inside the premium zone. The second uses CISD confirmation before execution. So, throughout this framework, the weekly chart provides the bias, the 4-hour chart provides the structure, and the 15-minute chart provides the precision entry used to align the entire setup in one direction. Although this example focuses on the weekly, 4-hour, and 15-minute charts using ES1 futures, the same framework can be adapted to different markets and multiple time frame combinations, as long as the alignment between bias, structure, and entry remains consistent. Now let us move into the real chart execution of the strategy step by step. The first stage begins on the weekly chart, where we identify the last major swing high as our primary point of interest. At this point, we are not looking for immediate entries. Instead, we are waiting for price to reach that liquidity level and potentially trade above it. Once the weekly swing high is taken, we anticipate that the market may begin a bearish reversal. In other words, we are looking for a liquidity sweep above the previous high, followed by signs of bearish price delivery returning back inside the trading range. Now, after the weekly liquidity sweep has formed, the next step is dropping down into the 4-hour chart to begin developing the rest of the setup. This is where we will start looking for structural confirmation and execution opportunities aligned with the weekly bearish bias. Now, here on the 4-hour chart, we have the weekly higher high marked as our primary point of interest. This level represents the major high from the weekly time frame and the liquidity level we expect price to attack before a potential reversal develops. At this stage, we are monitoring the 4-hour structure closely and watching for a possible change of character to begin forming. However, before that structural shift can happen, we first want to see price continue higher and trade above the weekly major high. As the next candles develop, price eventually breaks above the weekly higher high, which satisfies one of the main conditions of the framework. Now that the weekly liquidity level has been taken, we begin updating the structure markings on the chart. Since price continued moving higher, the possible change of character level shifts to the next 4-hour swing low. At the same time, a new weekly higher high is formed, because the previous weekly high has now been exceeded. At this point, we are no longer looking for continuation higher. Instead, we are waiting for a change of character on the 4-hour chart that may confirm a possible liquidity sweep on the weekly time frame. If the 4-hour structure begins shifting from bullish to bearish after the weekly high is taken, this can become the first structural confirmation that the higher time frame liquidity sweep may already be in place. As the chart continues developing, price suddenly delivers a strong bearish move on the 4-hour chart and breaks below the protected swing low. With this movement, the market forms a change of character, signaling that the bullish 4-hour structure may now be shifting bearish. This becomes an important moment in the framework because the 4-hour change of character now aligns with the weekly liquidity sweep that formed above the major weekly high. At this point, we no longer view the move above the weekly high as simple continuation. Instead, the combination of the weekly liquidity sweep and the bearish structural shift on the 4-hour chart now begins building the bearish narrative we were waiting for. Now, after the change of character is confirmed, the next step is defining the trading range. This becomes extremely important because the trading range allows us to identify the premium and discount zones of the move, as well as the optimal trading zone that we will use later for execution. Using the Fibonacci retracement tool, we can now project the OTZ between the 0.618 and 0.786 retracement levels of the bearish leg. This area becomes our potential premium retracement zone for short positions aligned with the bearish higher time frame narrative. However, at this stage, we are still not looking for the final execution yet. Once the trading range and the OTZ are properly marked on the 4-hour chart, we then move down into the 15-minute chart to begin searching for the execution models that will align with the higher time frame structure. Now, as we move down into the 15-minute chart, the bearish move from the 4-hour time frame becomes much more visible through the strong downside expansion. At this stage, we once again mark the trading range and identify the premium and discount zones together with the optimal trading zone on the lower time frame. One important detail here is maintaining patience and discipline. Even though price has already delivered a strong bearish move, the objective is not to chase the market, but to continue following the framework and wait for price to retrace back into the premium area of the range before looking for execution. In addition to marking the OTZ, we also identify the fair value gaps and order blocks positioned inside the premium zone of the bearish structure. These areas will later become important points of interest as we continue following the development of the setup and the execution process. The first possible execution model on the 15-minute chart is using the fair value gap together with the order block as the entry zone. In this scenario, the entry is positioned at the opening of the fair value gap, while the stop loss is placed above the order block. The target is set at the external liquidity level, creating a 1-to-3 risk-to-reward setup. The expectation behind this execution is that price may retrace back into the fair value gap, react from the premium zone, respect the order block without invalidating the structure, and then continue lower toward the external liquidity target. As we can observe, price retraces higher and eventually taps into the fair value gap, activating the entry. After the entry is triggered, price continues developing upward and comes very close to the stop loss area, creating temporary pressure inside the trade. However, if we zoom in and continue following the development of price action, we can see that the market spends a significant amount of time consolidating inside the order block and fair value gap region before finally continuing lower and reaching the 1-to-3 target objective. The second execution model is a more conservative and confirmation-based approach. Instead of entering immediately at the fair value gap, we wait for price to retrace back into the fair value gap or the order block positioned inside the premium zone, and then look for a CISD or change in the state of delivery to form on the 15-minute chart. Once the CISD confirmation takes place, the entry is executed on the candle confirming the bearish shift in delivery. The stop loss is then positioned above the high of the CISD movement, while the target remains the external liquidity level on the 15-minute chart. This creates a higher precision execution with an approximate risk-to-reward ratio of 1 to 3.5. As we continue following the development of price action and zoom further into the chart, we can observe that price respects the bearish confirmation, continues delivering lower, and eventually reaches the full target near the 1 to 3.6 objective. Now let us go back to the 4-hour chart and explore the higher time frame structural entry. Compared to the 15-minute executions, this approach is slightly more aggressive because the entry is taken directly from the 4-hour structure without waiting for lower time frame confirmation. Once the change of character forms on the 4-hour chart, we define the trading range and identify the premium and discount zones together with the optimal trading zone. Using the bearish leg as our reference, the entry is positioned directly at the 0.618 Fibonacci retracement level inside the OTZ. The stop loss is then placed above the weekly high that created the liquidity sweep, while the target is projected toward the external liquidity resting on the 4-hour chart. This creates an approximate risk-to-reward ratio of 1 to 3.2. As we can observe, price retraces back into the optimal trading zone, respects the premium retracement area, activates the 4-hour entry, and eventually continues lower toward the external liquidity target, reaching the full 1 to 3.2 objective. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.